Hi, it's Nick Raj here, and we're coming to the end of 2012, and you've probably been a little bit frustrated over the performance of the Australian share market over the last, 6 months, 12 months, maybe even over the last 5 years, depending on how you invest. And so today, I just want to have a small chat about potentially one part of the whole investing journey that you might be missing, and an important part at that. Really, when it comes down to it, there are 3 parts to success. Find a strategy that works, validate it, and do it. The first 2 are actually pretty simple because everywhere we look, you're going to find strategies, forums, books, courses, they're all out there. So first of all, find a strategy that works. Second of all, and more importantly, is that you have to validate the strategy and ensure that it works. You don't want to take someone's word for it, nor really do you want to accept traditional lines of thinking. I mean, just look what happened in 2008. I think plenty of fund managers who accepted the traditional lines of thinking got absolutely creamed with their returns in 2008, many losing 40 to 50%. Obviously, Unholy Grails, my recent book, I outline 8 strategies and have done the hard work for you. So suggesting a few different strategies and then validating them. So find a strategy that works, validate it, the easy parts. Lastly, though, the third part is actually doing it. And this is where it comes a little unstuck for most people, because there's 2 parts to doing it. There are the quantitative traits and the qualitative traits. Now, the quantitative traits, if we use the analogy of teaching a teenager how to drive a car, tell them to turn the wheel to the left to go left, turn the wheel to the right to go right, put your foot on the brake to stop, put your foot on the accelerator to go forward. These are teachable and repeatable traits that any teenager can comply with. And when it comes to trading, the same kind of analogy would be how to enter a trade, a specific setup, whether it be technical or fundamental, how to exit a position, how to diversify the portfolio, risk management. All of these are the kinds of things that we learn about from courses, seminars and books, and they're the quantitative, repeatable traits. Unfortunately, we don't get taught about the qualitative traits, and this is what makes the big difference. Again, if we use the analogy of teaching a teenager, how do you teach a teenager when they're driving to understand a dangerous situation developing, traffic moving in a dangerous way, and how to take defensive action when that starts to occur? It's very difficult to do that because it requires experience and feel. And this is the same with trading and investing. There are certain things that occur when we're investing that you're not prepared for. And as a result, these hurdles or these speed bumps come along every so often, and you think there's something wrong with your strategy and you give up. And that's the worst possible thing to do. So what I want to do is show you some very experienced traders and investors and show you real time what actually goes on when these speed bumps occur. So here's Warren Buffett's Berkshire Hathaway. You can see that during 2008, the share price and therefore his funds under management had a substantial decline, dropped 50%. Most fund managers in 2008 lost 40 to 50%. But at the end of 2008, do you think Berkshire Hathaway, specifically Warren Buffett, do you think he was going to change his methodology? Did you think his methodology doesn't work anymore? Did you think he was going to get into high frequency trading at the end of 2008? Because that's the trendy thing to do. 2009 he made a small gain. 2010 he had a good gain. 2011 he had a down year and underperformed the Dow Jones. Again, the question, he's had 2 losing years out of 4. Does that make him an erratic, poor investor? Well, the answer is obviously no. He certainly has a very, very long-term track record, and he understands that every so often there's a few bumps along the way, but he sticks to his guns because he knows eventually his positive expectancy will get him through. Now, the next investor I want to show you is David Drews. And here we have a 31-year track record. Not many Australian fund managers, in fact none that I know of, have a 31-year track record. Now take a look, he's got a since inception return of 17.4%, and that is after he takes 20% of the profits. So his annualized gain is up around 20% per annum. And consistency, last 15 years, last 10 years, last 5 years, all extremely good. 31 years. Now that's a pretty good equity curve there. $1,000 turns into $200,000 in 31 years. And the question is pretty straightforward. Would you like your super fund to increase in value at that same rate for the next 31 years? Well, I certainly would. It'd be fantastic. However, if we dig a little bit deeper into his returns, we can see there's lots of hurdles. He has losing months. He has losing sets of months. Let's take a look here. In April 1986 through to June 1986, he lost 30%. Imagine if you started a strategy and in your first 3 months you lost 30%. What would you do? You would turn it off. Have a look at September and October of the same year, 1986. He lost 38% in 2 months and then backed it up in November with another loss of 6%. Imagine again, if you'd lost 43% of your money in the first 3 months of a new investment strategy, what would you do? You would turn it off. Think about what David Drews does every single day. He wakes up and places his trades. He does it every day, every week, every month, every year, and he's done it for 31 years. But you can see here he has losing months, he has losing years. Now the average retail investor, I know for a fact, is not happy having a losing year. Imagine placing those trades each day, each week, each month for a year and having a losing year. Unacceptable to most people. But here is the truth. As we just saw with Warren Buffett, you can have and you will have losing years. David Drews stands up to the plate every single day, every single week, every single month, every single year for 31 years and places the trades again because he knows that his strategy has a positive expectancy over the longer term, and he knows that along that journey there will be bumps and hiccups that he just have to keep going. In fact, the only way that David Drews can fail is if he does not place the next trade. And think about that. How do most people fail? Because they hit a speed bump, a road bump, they get nervous and they don't place the next trade. What they want to do, what they do, is they go looking for another strategy. And 6 months into that other strategy, the exact same thing happens again. So the important lesson here, as you can see by these two long-term professional traders and investors, that speed bumps occur, frustrations will occur, but they get up, brush themselves down and keep moving forward. They do not give up. The only way they fail is if they give up. If you're interested in looking for some strategies with positive expectancies, take a 2-week trial of the Chartist. Simply hit the subscribe to the Chartist today button, select the 2-week trial, and then you can have a look at the strategies we've got. We don't have salespeople. You're not going to get a phone call. You'll get an introductory email from myself and an offer to chat about your situation, but there's no heavy-handed sales techniques. Give it a try. $19 for 2 weeks gives you access to everything that we offer. Thank you.